Hi everyone, my name is Dr. Winrow. I'm a tax professor and a tax attorney. I'm doing this video in order to help you better understand Section 1231 and Section 1245 recapture. I'm recording this because students often have a difficult time understanding these concepts, but there's some shortcuts that you can take that help simplify the process. So in this video, I'll walk you through those shortcuts so you'll be performing well on your exams, whether it's in class or on the CPA exam. So let's start by looking at a checklist for 1231 property. This checklist helps you understand the qualifications for 1231 assets. And then if we do have a 1231 asset, what we do is we have to determine whether there's going to be any 1245 recapture. So are we recapturing any depreciation that occurred when the business was using the asset? And if we have 1245 recapture, we then look to see, did any 1231 gain survive 1245 recapture? And that's where the 5-year look-back provision comes in. So you may be asking yourself, what is this? I thought you said you were going to simplify this. This isn't simplifying it. Well, we'll walk through the process. I will simplify it. So let's take a look at the next section, which we're going to then look at what type of property do we have. So we have to understand the character of the typical property. All right, well, let's take a look at the different types of character that we have whenever we dispose of an asset. So we can have hot assets, personal assets, we can have investment property, or we can have 1231 property. So hot assets are going to be assets that we're going to always treat as ordinary gain. And there are two types of hot assets that we need to be aware of when dealing with 1231. The first one's going to be accounts receivable, and the second one is going to be inventory. If you see accounts receivable or inventory, then we know it's going to be ordinary. And it makes sense if you think about it, right? So if we have a business and it's selling candy bars or water bottles, when they collect the money in this transaction, they have ordinary income. That's their primary function. Or perhaps it's a bigger asset. Maybe it's a PlayStation 5 or an Xbox. Well, when they sell that, maybe the customer can't pay for it all right now. So they say, hey, I'll pay you later. Well, when they do that, what's happening is there's an accounts receivable. And when they collect on those accounts receivable, they collect payment for that PlayStation or Xbox. Well, then that's going to be that's going to be ordinary as well. It's just as though they had sold that inventory. The second type that we'll talk about is a personal asset. Now, a personal asset is just about everything you use if you're not using it in a trade or business. It's your TV at home, it's your computer or phone if you're watching this recording on that device. It is your car, it is your backpack, it is the water bottle that you just purchased. All of those things are going to be personal assets. When you sell a personal asset, you have a capital gain if it's sold for a gain, and if you sold it for a loss, it's a capital loss. Now remember, if you have a capital loss from a sale of a personal asset, we don't get to recognize capital losses. The third type is going to be our investment property that's not being used in a trade or business. So maybe you have some land that you're just keeping and hoping that it appreciates. You have your stocks, you have some collectibles. So maybe you collect Pokemon cards, stamps, artwork, whatever it is. Those things will be capital as well. Now remember, capital assets are generally taxed at our preferred rate of 0, 15, or 20%, although collectibles have their own rate. The thing to keep in mind is that whenever you see a capital asset, they're taxed at a preferred rate. When we see our hot assets, which is ordinary, that's taxed at our ordinary rate. The final one is the one that you all are here for, which is the 1231 property. So 1231 property has to meet 3 requirements. It has to be a depreciable asset, it has to be used in a trade or business, and it has to be held for over 1 year. So if you have an asset that is depreciable, used in a trade or business, held for over a year, then you have a 1231 asset. So this could be something like a building. It could be things such as machinery or equipment, and we've held it for over a year. Now with a 1231 asset, we don't know if it's going to be considered a capital asset, which we would like it to be if it's a gain, or if it's going to be an ordinary asset, which we don't want ordinary, right? We don't want it to be considered ordinary. All assets, whether 1231 investment, personal, or hot assets, all of them are eventually going to be considered capital or ordinary. The question with 1231 is how much, if any, will be capital and how much, if any, will be ordinary. Now, we will figure that out as we go through 1245 recapture, because what it does is it takes the potential for a 1231 gain and it may convert part of that gain, or maybe even all of it, to ordinary instead of capital. Now, I'm going to teach you a shortcut that helps you figure this out, and you shouldn't have any problems with these types of questions after this recording. Let me say before we move on that with a 1231 asset, if there is a loss, we treat 1231 losses as ordinary losses. And as a taxpayer, we love that. We love ordinary losses because ordinary losses are offsetting our higher ordinary income. And that's great for us, right? So 1231 could be great. We could have a 1231 gain at capital, or we could have a 1231 loss at ordinary. But like I said, we'll go through 1245 recapture, and then there's also a 5-year look back. We're going to knock this out of the park, so you're not going to have a problem with those. All right, so we know what 1231 property is. It's depreciable property used in a trade or business held for over a year. So now, what's the big deal with it? Well, if it's 1231, we know that it might be capital or it might be ordinary. So what we have to do is if we have a 1231 gain, we have to go through two different tests. The first one's at 1245 recapture. The second one's a 5-year look back. So the first one, 1245 recapture, is telling us that if our gain is due to the depreciation of the property, so we've been taking out accumulated depreciation, well, that accumulated depreciation is going to recharacterize our 1231 gain, and it's going to say to the extent of any depreciation, then it's going to be ordinary. Now, I'm simplifying this. So here's the actual rule. When you have 1231 assets, you're going to go ahead and you're going to look to see, was it actually depreciated? So we're going to take the purchase price minus our accumulated depreciation, and then what's going to happen is we're going to have our adjusted basis, right? So purchase price minus the accumulated depreciation gives us our adjusted basis. Once we know our adjusted basis, we look to see what our sale price was. So we go sale price minus our adjusted basis, and that's going to give us our realized gain. Now our rule is going to be we take the lower of realized gain or accumulated depreciation. Again, this is one of those what moments. Again, I thought you were going to simplify this. I'm getting there. The way we simplify it is we're going to look through some problems, and I'm going to show you that for 1231, what you have to look for is, did you sell it for more than you purchased it for? If you sold it for more than you purchased it for, the excess is going to be 1231 that will survive 1245. All right? And then we know that at that point, all the recapture will be all of our accumulated depreciation. We're going to look at the problems. We're going to put that to the test, and you're going to have this down. All right, y'all. We're finally here. We're finally to the point where we can go through and see the shortcut because we know what 1231 property is. We understand that 1245 is trying to recapture some of that depreciation. So now this is where it all comes together, and you're going to have this concept down after this portion of the video. So what I did is I created some problems for you. I've got 2021, 2022, and 2025. So no transactions occurred in 2023 or 2024. All right, so those are the year of the events. So we have assets, equipment, machinery, and then what you can see is we go with our purchase price, accumulated depreciation, adjusted basis, sales price. Okay, so let's start working through each of these. Now, we see that we purchased it for $100,000 we have accumulated depreciation of $50,000. So if we take purchase price minus accumulated depreciation, we get to adjusted basis. Simple enough. Purchase price minus accumulated depreciation equals our adjusted basis. Then we look at our sale price. Now here's the first thing I can tell you. I can tell you that in 2021 we will not have any 1231 gain. And here's how I can tell you. See, first off, it's an equipment we're assuming it's going to be held for over a year. It's being used in the trader business. We're making a couple assumptions here. But here's why I can tell you we're not going to have any 1231 property. Or 1231 gain. The only time that you're going to have 1231 gain is if your sale price, right here, is greater than your purchase price. If that doesn't happen, there will be no surviving 1231 gain. We don't even have to look at the 5-year look back. All right, so that's what we're looking at first. So what we have here is $30,000. We said that the adjusted basis is $50,000. So let's go ahead and actually calculate this out. So what is our realized gain? Well, realized gain is going to be our sale price minus our adjusted basis. So $30,000 minus $50,000, we sold it for less than our adjusted basis. When we sell something for less than our adjusted basis, that means we have a loss, right? Well, a 1231 loss, it can't be recaptured. 1231 losses will always be considered an ordinary loss. So we have a 1231 loss, $20,000, because it was sold for below the adjusted basis. Now we'll take this amount and we're going to move it over to the 5-year look back, but let's not worry about that right now. Right now, like I said, we were more worried about just making sure we have this concept down. All right, in 2022, we had machinery. Purchase price is $80,000. Our accumulated depreciation is $50,000. Our adjusted basis is $30,000. And our sale price is $70,000. So think for a second and decide whether we're going to have any 1231 gain left over after this. Hopefully you're able to find out extremely quickly and you didn't even have to pause this video. If you did, hey, we still have another example. You're going to get this. So what we're looking at is our sale price is $70,000. What did we say? We said that if the sale price is greater than the purchase price, then we're going to have 1231 gain that will survive 1245 recapture. Here we sold it for $70,000. We purchased it for $80,000. So because our sales price is not greater than our purchase price, we're not going to have any 1231. We're finished. Any realized gain is going to be recognized. That's the amount that we have, and it's going to all be 1245. All right, and once it's 1245, it's ordinary. So let's look at this. 80,000 minus 50,000 accumulated depreciation tells us our adjusted basis is 30,000. So what is our realized gain? Well, we take the sale price minus our adjusted basis, 70 minus 30. It means that we sold it for more than what we had for basis. So we have realized $40,000 of gain. Okay. Our rule was we take for 1245 the lower of accumulated depreciation, $50,000, or our realized gain, which is $40,000. Well, $40,000 is lower than our accumulated depreciation, so we're going to go ahead and we're going to recapture all $40,000 of gain. It's now $1245, and it's now treated as ordinary gain. Not what we want as a taxpayer particularly, but that's the way that 1231 and 1245 read. So let's go to the last one. We skip a couple years. We didn't have any transactions going on. Now we're at 2025. We have machinery, which is our asset. So we're getting rid of a business asset again, assuming it's been held for over a year. It's depreciable property, and it's being used in our trader business. So let's look at this. Purchase price is $200,000. Big piece of machinery. Accumulated depreciation, we've depreciated it by $80,000, which gives us our adjusted basis of $120, and now we have a sale price of $230,000. first step we're doing here is we're going to look and we're going to say, okay, do we have any 1231? And the answer here is going to be, hey, we do. This is an example where we're going to have some 1231, which we're now going to have to go to the next test, the 5-year look back. But let's look at why. The sale price here is $230,000. That's more than our purchase price. When you see that, this is your signal. When you see that, you know you have 1231. And how much 1231 do you have? $30,000. We can tell right off the bat the difference between sales price and purchase price. You see, whenever you sell an asset, right, and you have a gain on that asset, the gain can only come from one of two places, or a combination of the two. It's either because the property appreciated, or you have property that depreciated. You've been recouping your investment in it, right? So if it's because of depreciation, we already got the credit of an ordinary deduction. So what we're going to do now is we have to come over here and it's going to be ordinary gain, right? We're recapturing it because we got that benefit already. Well, what will happen in this one, and before we take a look at the answer, we're going to say 230 minus 200. $30,000 is going to be 1231 because the sale price exceeded the purchase price, and all 80,000 of accumulated will be 1245. We're done with this, right? We're done with it. So let's look at how the math plays out so you can see. Okay, so 200,000 purchase price minus the 80,000 for accumulated depreciation gave us an adjusted basis of $120,000. We sold it for 230. So what is our realized gain? Well, 230 minus 120 gives us $110,000. So we have $110,000 of gain. Our rule is 1245 recapture is the lower of accumulated depreciation, $80,000, or our realized gain, $110,000. Well, 80 is lower, so 80,000 was recaptured. That leaves $30,000 remaining, which is 1231. But we knew that right away, right? We already knew it. That is what 1231 and 1245 is. It is a simple process, and once you can understand what's going on, the problems aren't so difficult. You'll be thinking, hey, bring on more of those problems, pad my grade, right? I'm going to be a CPA in no time, or I'm going to ace this test that I have coming up. So I hope that you're getting some confidence on this, that you're seeing what the process is. Now, what we're going to do is we're going to go ahead and we're going to look at the 5-year look back. It's not hard. We're just going to take a look at it real quick and explain why we have a 5-year look back period. Before we do, what I'll do is I'll put up a solution that I created for these problems that show you the arithmetic on it, the computations. So that way, if you're still not exactly sure what I'm saying, you can see the math, and maybe that will help resonate with you. All right, everyone, here's the solutions that I was telling you about. So you can see for the equipment, we had a $20,000 realized loss. Because it's a 1231 loss, we treat it as a 1231 loss, and that's going to be treated as an ordinary loss. For the machinery, what we did is we looked through here, we did our calculations on that, and we said, okay, $40,000 realized gain is going to be over here versus our accumulated depreciation. Because of that, we had $50,000 of accumulated depreciation. Everything was going to be recaptured, so that gain is going to be recaptured. We don't have any 1231 that's going to survive. All that will be 1245 recapture, treated as ordinary. Then we have our 2025 machinery, and this is the one where we said, okay, we had $30,000 that was surviving, and the reason we had that was because our sale price exceeded our purchase price, so it had appreciated, our asset had appreciated by $30,000. That's what resulted in our 1231, and that $30,000 is what goes on to the next level. All right, hey, if this is helping y'all, well, do me a favor and subscribe to my channel and like this video. But let's continue on, and what I want to do is I want to show you we have our $20,000 realized loss here that we said from 2021, and then in 2025 we said $30,000 was going to survive, and it's going to the 5-year look back. So let's go ahead and take a look at the 5-year look back. I created a problem to where we're going to be able to see with the 5-year look back that we took the 2021 loss and that we're going to take the $30,000 gain, 1231, that continues through 2025. So this is for our 1231 5-year look back rule. And what happens is if you had a 1231 loss in the past, well, we treated that as an ordinary loss, right? So we got the best of both worlds. We got to take an ordinary deduction. We got to take it against our ordinary income. So we were super happy about it. Well, the code now comes back and says, all right, not so fast here. What we got to do is we've got to come back here and look to see if you've had ordinary losses before, because if you did, then any 1231 gain that survived that last test, our 1245 recapture test, now that has to be recharacterized as ordinary to the extent of those losses. So here's what we're looking at. Let's say in year one, what we have is we had that loss of $20,000 from the last problem that we were dealing with, right? And I believe I said that was the equipment. So we had a $20,000 loss from the equipment, which we said was a 1231 loss. Well, we put this on our list, and it's now part of 2021 year, so 2021, and we have a $20,000 loss. We said nothing happened in year 2 or 3, so then we get to year 4, right? In 2024, what we did is we had we went to year 4 and then we went to year 5. So 2025, I think, is what I used on my last part of the problem. I said we had a $30,000 1231 gain, right, from the sale of the machinery. So now we have this gain that survived it because of the appreciated property. Well, what we have to do is we count back to our 5 years, right? So we go all the way back. So if we're in 2025, we go 2024, 2023, 2022, 2021. We're going to start at 2021 and work our way up here. Well, we didn't have anything that happened in years 2, 3, or 4, so we're not even worried about that. But what we did have was that $20,000 loss in year 1. So 20,000 of our 30,000 that survived the 1245 recapture now has to be recharacterized as ordinary. So we have $20,000 that we recharacterize as ordinary, but we did have $30,000 of gain, so 10,000 of it survived. It's 1231. Finally, we're done. Out of all that work, what we're saying is we have $10,000 that will now be treated as a capital asset, a capital gain, right? So now we have capital instead. So that's the process that you go through as you're working on this. So by the way, after we finish this, after we knocked off the $20,000, then we don't even have to worry about it again. This will just be 0. So it's not like you have to continue to catch it in that 5-year look back. Even if this had been in year 4, after we've already recharacterized in the equal amount, then this is zeroed out. So it won't be impacting future years after that, even if it hadn't fallen off the 5-year cliff, right? Well, I hope this helps. I hope that I met my promise to you that I was going to go ahead and get you to understand this. If I did, please go ahead and subscribe to my channel, like this video as we continue to grow.